Hey, it's Delay in this episode 326 of the Orange Pill Investor. I might have put the wrong did I put the wrong description? No, 326. I don't know. For some reason, it hasn't refreshed on YouTube, but I see folks commenting, so we shall see. What's up, Jeremy? What's up, Russ? What's up, Howard? Uh, Howard says, "Man, you always start just as I have to get in the car. Looking forward to catching one live one day." Yeah, my wife told me, like, "Look, you gotta have a schedule and, start treating it like a real job." And, I couldn't help myself. I stayed up watching football last night. When I say watching, I mean, like, uh, watching half the game and just falling asleep and rewinding to catch the parts that I missed. But the, um, the intro was "The Formula" by DOC, and I thought that was appropriate because I wanna talk about the formula that I used for, uh, making money in my portfolio by giving away all of the videos for free. It occurred to me when I was listening to Tom Sosnoff talk recently, and he's the guy that I learned much of the option seller's perspective from. Watched tons of their research videos, and the other one was In the Money's channel on YouTube. I've linked his channel before. But the way that Tom described the Tasty Trade model is that they just give away all of the research. They give away all of the strategies, and their hope is that in return, people will use their product. And he called it the Goodwill model. And I thought, well, that's basically what I did in 2024. Originally, I kind of thought in the back of my mind, like, okay, I'll put out content and I'll structure it this way and that way and try to drive engagement. And some of that worked. Um, but what I really think happened was simply giving all of that away. Uh, I'm still waiting on a check from Elon. I'm not monetized in the slightest. And YouTube, the other day, I forgot my YouTube was connected to a different email address, kind of a spam folder that I don't really check. And I went in there and I was like, holy shit. I had like a dozen copyright strikes for all these intros that I used at the beginning. And I just thought that was hilarious because what do I care? I'm not I don't earn a dime from YouTube videos anyway. Maybe someday I'll have to tiptoe around that, but I can't imagine that YouTube's ever gonna pay me enough to outweigh my own trading income. So, that's kinda nice because then I can just cuss anytime I want, and I can get copyright strikes all I want, and if they, demonetize something and I'm making $10 a month on it, I really just don't give a shit. Um, and so even though I've never made a single dime off any of the content I've created, I think just that proof of work and that Goodwill method is what got me an invite to the True North, um, group, and even if I hadn't gotten that invite, it's still connected, the algorithm basically connected me to that Quant Bros 1 episode, and even if they never figured out who the hell I was, I still would have been, benefited greatly from that association, and I adjusted my trading strategy and added a bunch of long leverage in there, and, if I had just okay, let me just slam it all into Bitcoin. Okay, that's cool. I would have doubled my money in 2024. It was up from 40 to what was it at the end of December? Yeah, about 100. When did we hit 100? hit 100 in December. So, doubled my money in 1 year, but I was able to actually and if and if we look at all-time highs, I think my portfolio was up like 7, 8, 9x, something like that, if we wanna go to all-time highs, but I think it's down like 60% from all-time highs, which sounds bad, but when you're up 3x over a year period, you, seems ungrateful to complain, about being down, from all-time highs. But I think that, that Goodwill method works for me, or it did work for me, and I'm not saying, like, "Okay, if you're gonna open up a lemonade stand, you should just give away the fucking lemonade." It's a little bit different scenario there, but, it also kind of resonates with the way that MicroStrategy is doing what they do, because they're just opening up the playbook for anyone to copy. So Semler's copying it. Who's that new company? Battery storage or something? Was it Cooler? I kind of took a look at their options, but they just have the monthly, so it wasn't really all of that interesting to me. But if they get weeklies, I'll probably have to add some positions because that'll just be fun. But yeah, I think I just kind of like it. I like the way that giving things away created the ability for me to just be associated with smart people, and then I was able to benefit indirectly from that. So I just thought that was kind of cool. Every once in a while, I still keep an eye on my impressions for X, and maybe I'll get monetized one day. But it's definitely worked. Tasty Trade having the using the Goodwill method has definitely worked because I would say I have 90% of my money on Tasty Trade and maybe, I don't know, 5-10% on Robinhood, even though I can trade for free on Robinhood, and I probably pay like $1 per contract or something on Tasty Trade. But because of the goodwill that they have generated, I'm willing to almost treat it as a tip. Like all of the value that I've gotten from Tasty Trade is worth me tipping them a buck a contract. It also it's a lot easier when a contract is worth $1,000 to tip them $1, whereas in my Robinhood account, if I've got, I'm selling a covered call on CLSK and I'm only collecting $19. If I had, let's just say it's 20 bucks. If I had to pay them $1 to get into that contract, that's like 5% of my profits. So trading small contracts would be cost prohibitive on Tasty Trade. So I'm definitely not saying that anybody with a $5,000 account or even a $50,000 account, like, oh, you should definitely trade on Tasty Trade and pay them $1 a contract. No, I mean, absolutely. I started on Robinhood and I benefited greatly from them, giving me some free trading. And to a certain extent, I have a little bit of loyalty towards them as well for that reason. Um, Still a little bit bitter about removing the buy button for GameStop back in the day. I only had a small trade in there and didn't really make much money off of it. But you have to be careful when you've earned loyalty because it can take months or years and it can just, in the blink of an eye, you can lose all of that goodwill that you've built up. So I've still got my small positions on Robinhood. And I think that makes the most sense because most new traders are probably just opening up a Robinhood account. Anybody with 5 or 10 grand that's like, "Oh, I wanna try options. I wanna lose all my money in options." They're probably opening a Robinhood account. So, I think it also makes logistic sense to demonstrate some of these smaller trades on Robinhood. But anyway, that's all I've got for that. So I think I missed what's MicroStrategy at right now? Okay. So I missed it and then I didn't. Now maybe I haven't missed it. I think MicroStrategy was down to right after the open was down to 307. And I was like, okay, cool. I should close some contracts while the price is low. And then of course I had steak and eggs and an hour later the price was up like 5% or something. And I thought, maybe I won't make any trades today then because I kind of missed it. But now it's coming back down, so this is gonna be a perfect opportunity to close some covered calls that I put on last week and maybe keep half the profits. I'm gonna check chat before I do that, and then we'll get down to business. Yeah, Jeremy says it was good to finally have a close game. I still gotta watch one. I watched Denver, and I won't say what happened in case I don't wanna give any spoilers, but I watched that game, um, and then I watched the Philly game, and I what's the other one that I still need to watch that was recorded? Anyway, there's one that I haven't even bothered to watch yet. K4 says, "Hi, boss. Cannot believe we have yet another red day. Even Joe McCann from Asymmetric is short-term bear table." I'm not sure who that is, but they must be a perma bull if they're turned bearish. Jeremy says, "Are you coming out with are you coming out with a convertible bond? I'll buy it." Long Nithu. Man, I had delusions of grandeur when I was up like 789x in November. I was like, "Holy shit, I should start a frickin' investment group or a hedge fund or an ETF or some shit like that." I still wouldn't rule it out, i- in the future at some point, but it's also It's also not to nice not to have any responsibilities to anyone. Like, people have reached out and said, "Oh, I'll pay you for options coaching or whatever," and it's a little tempting, but, ultimately, I decided not to because it's just so stress-free to, just trade my own money and not have to worry about whether, uh whether my advice is actually working. Alright, so let's jump on some trades before fricking MSTR reverses course. All right, I sold 5 of the 330s on Friday. So it says days open 3, but that includes the weekend, and I kind of don't really count the weekends. So usually Wednesday is halfway for me, and I can buy this back for less than half of what I paid, and it's basically 1 trading day, 3 if you count the weekend. So more than half of the value of this contract has drained out, but there's still 4.5 trading days left. So this is a perfect opportunity to close these. And the only decision after this is whether to roll down for a credit or just leave it as is. Damn, that was a little too loud. I forgot to turn this down. Now, of course, closing those gives me a little bit of margin use. And this says settled cash balance 4,700. I think that's because I did a withdrawal to pay some bills. So let's see if I'm using what did I just close pay for these? 400 bucks a pop? No, 600 bucks a pop. So that was about 3 grand. Interesting. So after all that settles, I'm not sure if I'm going to be using margin or not, or how much margin I'm going to be using. I'm not sure how to math that exactly right. But in general, when the price is down, I like to add leverage. So I don't mind selling shares to add leverage. And since options are kind of backwards, especially as an option seller, you want to sell high and then buy low. in this case, even though that the price of MicroStrategy is down for the week, if I only look back in a week, selling shares sounds like that would be selling low. But if I'm selling shares to buy leverage, then that fits with my philosophy. And whether I buy to open a new position or I buy to close, like I just did with these positions here, those are materially the same, in my opinion. They achieve the same purpose. So I'm either, whether I add a new long leveraged position or I remove um, a leveraged position that was limiting my upside. Those both do the same things, in my opinion. Now, the only thing that I don't like as an option seller is now my theta just went way negative. Meaning there's more money draining out of this account every single day than is draining into it from trades. So I may go ahead and and roll those 5 down. Let's see. But it's not the end of the world if I have a negative account just for a week, because I'm kind of waiting to see what happens on January 17th. It could be a complete nothing burger, and maybe nothing happens on the 17th. We keep talking about it with as a historic option expiration because there's a potential if the market makers are under hedged, we could hit a gamma squeeze or something. But describing it that way maybe psychologically puts too much weight on it actually happening. And I think that's dangerous to assume. Like, I don't wanna add any when I'm saying I wanna add leveraged positions, I don't necessarily wanna add a bunch that would expire this Friday and just I need something to happen within 24 hours or I lose a bunch of money. So, I'll probably add some positions on Thursday, but I've got a few days to think about how that's going to look. So, just to maybe soften this negative theta a little bit, maybe I just closed 5 positions. But maybe if I open 3 new ones, hmm, looks like I just spent 3 grand closing those, so if I sell 3 new ones, approximately at the money oops, I need 3 of them. See if that takes care of my margin use problem and some of this negative theta. Okay, so that softened the blow on this negative theta value here. So I have much less money draining out of my account every day uh, than when these were all just closed. So I had 5 short positions. Now I only have 3. So I like that. And it looks like I'll have 2 grand in cash. I don't know why that would be. I thought I just spent 3 to close those 5 accounts. Were those the 330 strikes? Yeah. Okay. I don't know what's going to happen after these funds settle. We'll see. So I'm going to leave that with a couple grand cash balance. That's not the end of the world. Let me check any other positions. I don't think there's anything else I need to do. This 660 called debit spread is absolute garbage. And this is kind of an important topic, so maybe I'll just go over it. A call debit spread is supposed to be a defined risk trade, meaning I spent what is the difference between these two values? 28 and 23. So about $500 a pop on each of these. So most I should be able to lose is $500 a contract because if I get wrecked on one contract, I'm the buyer of the other one, so I can always just if they exercise on me, I can exercise back on them, and it should work out to the most I can lose is whatever I paid. However, there have been instances where people have lost thousands upon thousands of dollars on these, in air quotes, defined risk trades because if the price is hovering, around like the 660 strike, I bought the 660 and I sold the 760. And if there's a timing issue where the price is right around 660 and they exercise on me, and then the platform will probably exercise on my behalf, or if I just manually did it, I could exercise my contract as well if I didn't have 100 shares of the stock to give them. And then if the price reversed a little bit, like then if the price dropped down to like 645 or something, maybe even after hours, they could reverse that call that they exercised. So now, since the price is like 645, they don't want to buy them for 660 anymore. But my exchange isn't going to reverse the call that I exercised. So now I'm trying to buy stock for 760 a share, and the price is now collapsing. So that has happened to people, and this is kind of probably a bad example because the price is so different. Like, um, but on something that was like a 665, 670, and it's only like $5 wide, the price is hovering between those, and you're either gonna like win or lose the whole thing because the price is teetering around the break even. So that was the long ass way of saying that these ones that I sold and are worth nearly nothing, I could just buy them to close and take all of that risk off the table and just leave the long calls and let them expire worthless. Just make sure I have that right. I hate the way that Tasty Trade lists their and wait, do I have that backwards? Did I sell? Did I sell the 660s and buy the 760s? Hold on a second. Let me try to recreate this damn thing. If I was setting up a call debit spread right now, I'd have to, yeah, I'd have to buy the 355. Oh my God, it's too big. And then sell something cheaper, farther out of the money. Yeah, so I bought the 660. And so actually I think I gave that that example a little bit wrong. It would have been with the 660, 760, the price would have had to have been hovering around 760 for the 760 call buyer to want to exercise. So, yeah. But anyway, the moral of the story is that defined risk spreads are only defined risk if you don't get into that weird situation where the buyer of the leg exercises on you, and then depending on what happens with the price, if they reverse that exercise, but you are still exercising your half of the contract, you're on the hook for all of that money, and the price of the stock can go against you after hours, and you can get screwed. So that's the point. All right, so do I want to close these positions? It's only going to cost me 10 bucks a pop to get rid of these. So that makes sense to me. And now the only thing left are these calls that I bought. And I could try to sell them for whatever, but there's no reason to actually do that because there's no risk. There's no risk in an option that you buy, only risk in options that you sell. So if we get some kind of amazing reversal on Friday, then maybe I'll be able to recoup some of this value. But unless we see 700 a share, these won't actually go into uh, to profit because my break even price is going to be 660 plus 3 grand. So my break even is going to be like 690. Anyway, so mechanically, that just makes sense to me is to buy back the calls that I sold and take that risk off the table. Yeah, nothing else for me to really do with any of these positions. Let me just check the uh, the chat real quick, and then I'll keep moving. Jeremy says 0 DTE lotto tickets. Yeah, I don't know if I'm gonna do a 1 DTE lotto ticket on the 16th or if I will choose some expirations that are, you know, 90 days out. Maybe that'll be a little safer. So we'll see. I'm gonna chat with some other folks that are interested in doing something like that on the 16th. Jeremy says, not that I'm gonna do it, but is a 0 DTE just buying a weekly that expires at market close that day? Yeah, you would do it on the 17th. If you're gonna do 0 DTE, you're buying a call on the 17th, maybe in the morning, us, crossing your fingers that some giant move happens that day. And there can be very large swings in the value of options when they have such zero, such low time value left in them. Patrick says, as an option seller, do you prefer call debit spreads or put credit spreads? I would think a put credit spread is better because you're a seller collecting theta. Max profit is lower though. Yeah, as an option seller, the credit spreads are generally the go-to, philosophically. But because I've been so bullish on MicroStrategy, I added a ton of long calls. And the 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 call debit spreads that I had for the 17th were all losers, I believe. But I've still got 10 call debit spreads out into June that I'm still optimistic about. If I try to close them today, let's see what could I get for them. Yeah, 300 bucks. I think I sold them for 5, 6, 7, maybe even 800. I forget. Let me look and see if I can figure it out. Yeah, my trade prices for each of these. So 73 minus 65 was 8. Yeah, sold them for 8. They're only worth about 300 now. But if we can get some nice moves between now and March, then I might be able to break even or make some money off of these. So really, it kind of depends on the Ivy rank. So with Ivy rank being low, I might be less inclined to sell credit spreads. And when Ivy rank is 50 or above, I might be more incentivized to sell credit spreads because you're going to profit more from the option that you sold than you will lose on the option that you buy, because when you're setting up a credit spread, the credit leg is going to be closer to at the money, so there's going to be more value in it, even though both of the legs are getting pumped by implied vol. The out of the money one is getting pumped less. So, being extremely bullish, I was willing to set up some call debit spreads, but when IV rank is high, I think that's the tiebreaker for selling call, either selling call credit spreads or put credit spreads. Like if you're still bullish, the put credit spread is going to be more valuable if the price is going up. But there could be an argument made that if MicroStrategy, doubles or triples in a short period of time, you could be a little bit bearish and sell a call credit spread. But I haven't set up any call credit spreads on MicroStrategy this year, and I can't imagine myself uh, doing that over the next year unless, yeah, no. I'll be adding covered calls when Ivy rank is high, but I don't feel the need to really use the credit spreads as much. With a smaller account and you just can't afford 100 shares of something and you really want to participate, then I think that makes sense. But the spreads can be more capital efficient, but yeah, I'm not sure I'd be interested in too many credits, call credit spreads on MSTR that could cause me to lose my entire position. Again, a credit spread should be a defined risk trade, but participating in a defined risk trade that's win or lose and shorting MicroStrategy, it doesn't sound appealing to me. At least when I'm selling a covered call, I'm collecting premium, and the worst thing that can happen is my shares get called away at a profit. So I don't mind capping my upside on MicroStrategy in that sense, because that's kind of like a win-win scenario. But selling a call credit spread and number one, capping my upside and having to be directionally right that MicroStrategy goes down, I don't like that. I don't I don't like that setup at all. That scares me. Cheating Crypto says, "Hey Nithu, not sure if you have covered it yet or not, and definitely not financial advice, of course. Do you have any thoughts about MicroStrategy price action for this week's historic January 17th options?" So I'm gonna take a position that's small enough to take advantage of if we do get some price action, but I don't do TA, I don't make price targets, I don't, uh, I don't have valuation models or any of that stuff. I basically ask myself if I am bullish or not, and then I take positions. I take positions on that. So, no idea if anything amazing will literally happen on the 17th, or if the 17th could just be a springboard for some price action that takes, 2 to 4 weeks for something to happen. I don't have the slightest idea how it works. Um, there've been a couple of good write-ups in Irresponsibly Long, talking about how a gamma squeeze could work, and, there's other people with price targets out there. I think Josh has got, um, a graph, maybe something would happen on Friday. But yeah, I'll take a small position that if it hits, I'll be like scratching off a lottery ticket. And if it doesn't, it'll be like, yeah, just scratching off a losing lottery ticket, and I'll throw those in the garbage. But, you know, I'm not gonna put more than, I don't know, 1 or 2% of my portfolio on something degen like that. So, something, slightly meaningful, but not meaningful enough for me to bat an eyelash if it goes to 0. And especially if I buy something that's 90 days out and nothing happens, like, I'm only gonna lose 1 day of decay if if I decided to, like, nothing happened and I wanna close the positions on Monday. It's like 1 weekend of Theta, it's not a big deal. Um, or if I have, 90 to 180 days to expiration, then I can just leave them and watch them for a little bit without worrying about too much decay, um, from a losing or a bad trade. Dr. Van Nostrand says, "Do you ever utilize synthetic covered calls?" So when you say synthetic, do you mean where you buy a call and a put at the same same strike and expiration date and use that as a synthetic stock? Or do you mean like a poor man's covered call where I just buy these in the money calls a year out and then sell covered calls against them? So I am doing the poor man's covered calls, but I have never really done the synthetic stock version, which is what I think MSTY does. If you look out, they'll buy calls and sell puts on the same strike, same expiration day, like 6 months out approximately, and then they're selling covered calls against those positions. I've never understood how it was valuable unless they're getting those on margin somehow, and maybe the margin discount is bigger for the options than it would be just buying 100 shares. Yeah, I don't know how it's even an advantage, but if you can clarify that. Poor man's covered calls, yeah, I definitely have poor man's covered calls on. So these 5 leaps, I'm selling the 470s. These have been on for 17 days. And now that you mention it, I can buy these back for half of what I paid. So again, this makes sense to go ahead and roll. So let's see. Roll expirations. If I roll out to 228 from February 7th, I can collect about a 761 credit. If I can get a fill, that is. These positions will probably be the first to close. If MicroStrategy rips up, then I will just go ahead and sell all of these leaps to pay to close out the covered call strikes. All right, so that put another 3,500 into my account. So I think I will dollar cost average into another one of these June 1080s. How many do I have? I've got 17, so I will buy another one. Wait, how much are they? They're 1,400. Yeah, let me just grab one more. So the poor man's covered calls are great in a bull market, but they will absolutely get destroyed in a bear market. So you have to be very careful that you do not get overconfident, like, oh, these poor man's covered calls are printing money in a bear market and they'll just print money forever. The value of those leaps will absolutely get destroyed if the price for some reason of MicroStrategy were to drop down to like, 200 or even 250 a share. The value of these leaps would absolutely get annihilated, and the covered call profits would not be able to keep up unless you were just selling extremely, extremely aggressively. And even then, I'm not sure it would be able to keep up. So there can be an efficient use of capital, but if you're not very, very sure about the price staying at least the same, it can lose you a metric ass ton of money. All right, cool. Let me move on to the IRA. I have no cash, which I like. Again, I've got 2 leaps and I've got 3 covered calls on. So I generally like to keep, Tasty Trade doesn't really care if I have these covered calls on versus these. Like it's not associating, okay, he wants these 3 covered calls against his shares and he wants 2 covered calls against his leaps. You can set it up that way in Robinhood so that they're a little bit connected into one kind of like a calendar spread. But I don't know how Tasty Trade's algorithm actually keeps track of this. But I actually designed these 450s, two of these three 450s to be against these leaps. So this is a poor man's covered call as well. And then one of these and two of these are against the shares. It would be dangerous to sell at the money covered calls against leaps. You have to be very careful about choosing the strikes. A good rule of thumb for a ballpark would be to add the strike to its value. So 175 and 175 is about 350, right? So I wouldn't want to sell covered calls below, too much below 350 in a poor man's covered call, but I can sell the 330s against shares because it doesn't matter how high the price goes. I can just, let the shares get called away. But it does look like, you know, I could potentially package up a couple of these to try to sell more covered calls. I'm not sure if Tasty Trade would actually let me though. I think it threw an error the last time I tried to sell like a ratio spread. So I may actually have the maximum number of covered calls I can even sell here. And this will be interesting since it's a cash account. I can't even close these for 1600 because I don't even have the cash to close them. So if I want cash, I would actually have to sell shares in order to close these. All right, so if I sell, what, to get 1600 bucks, I need to sell 5, maybe 6 shares. Um, but if I roll these down and collect another credit, yeah, let's sell 6 shares. That'll give me the cash I need to actually close these 2 positions. How much cash do I got? Oh, 394. Okay, so I did sell one more share than I really needed to. But again, this is an IRA, so it doesn't really matter if I trade in and out of stuff. I'm not going to get hit with any tax consequences. So, do I want to roll one of those down and sell at the money? I think I'll stand pat with the IRA and just leave these 3 covered calls on. If we get a green day, maybe I'll add a couple more back on. But then what do I do? Should I buy one more share? Yeah, let me just buy a share back again. There we go. Uh, Anders, what's up, Anders? Once we hit a bear market, what strategy would you use to write calls? Synthetic long. At the end of 2025, I will not have any leverage. So I'm not going to own any long calls whatsoever. All of my MicroStrategy positions will be shares, and I will be aggressively selling covered calls against those shares. So that if we do enter a bear market, some people are saying, oh, strategic Bitcoin reserve means we hit a super cycle and there's no more 4-year cycles anymore. I am going to assume that the 4-year cycles continue because the penalty for being wrong about that is not much. It just means I get some shares called away at a profit, at an insane profit. Um, but if I assume that the 4-year cycles are over and it's just number go up forever, and I'm wrong about that, and I'm holding a bunch of long leverage, or I'm only, not very aggressively selling covered calls, and the price goes down, then my account's going to go to hell. So after I've captured a bunch of the bull market, I don't mind missing out on even more of it that may or may not happen anyway. Patrick says, as a reminder for us, you plan on rolling your June 1080s around April or so, right? Once we get under 90 days, you'll roll the long calls. Yeah, exactly. So if I, in the other account, I had a bunch of I guess I don't have any 1080s in this account. Yeah, I don't like holding long leverage under 90 days because theta starts to increase. And then at 45 days, it's really accelerating, um, which is why I'm selling these covered calls at 46 days. Um, I kind of broke that rule with, well, these 1080s were the, kind of broke that rule when there was tons of FOMO in November and bought some of these 1080s. Um, that didn't have to be a mistake, but in this case, it absolutely was because the 3,600 that I spent on each of these is completely vaporized. Um, and it's just a reminder that if you never want your long calls to expire worthless, you can just never let them expire at all. So if I buy them at 180 and I sell them at 90, then they'll at least have some kind of value, most likely. And yeah, so the June 1080s, where are they? Are at 158 days to expiration. So in 68 days, I will make some kind of decision whether to hopefully take some profits. And depending on how profitable, maybe I take half the positions off, 3/4 of the positions off. We'll see. But anything that I keep on, or if I'm still bullish, then I will roll these out to June, July, September. Oh, good Lord. July, August, September. Just to make sure that I'm not repeating this mistake of holding long calls under 90 days. If you're a day trader, swing trader, momentum trader, and you know how to trade these long leveraged options profitably, then knock yourself out. I'm not saying that they can never be profitable because every option in the market is priced correctly. It's just that some of them either are have the attributes for the strategy that you're trying to implement and the strategy that you know how to execute, or they don't. There was a YouTube commenter that was, when I said that I agreed with Tasty Trade's philosophy that all of the options are priced fairly and there's no theoretical edge, um, then he was kind of questioning, well, why do I sell a lot of these covered calls at 45 days to expiration? Because if there's no edge in, like, for example, the delta, I don't always just go to point one, point two, point three, etc. He said if there's no advantage in selecting point 0.1 delta over point 0.3 delta, then why would there be a an edge in theta? And my response is that um, delta goes into the price, so the price is fair. However, when we look at the Greeks for the option, it has theta, but what's not priced in is the rate of theta's change. And the rate of theta's acceleration changes from week to week and month to month. And according to Tasty Trade's research, it accelerates drastically at 45 days to expiration. And if we want to just do a little quick like gut check to see if that's true or not, we can go out to 368 days to expiration, and we can look and see what theta is. Let's just say at the money. It's negative 14. Okay. So 14 cents draining out every single day. And let's just go to 94 days. Just got to keep that in the back of my head. 14 at the money. So now over double that value is draining out of long calls at 90 days to expiration. And then 40. And let's go to 45 days to expiration. Now it's 44. And let's just start going weekly now. 46. 21st. Wait, did I just look at 46? 46, 14, 58. And let's look at one more, the 14th. Actually, we'll look at the 14th and the 7th. Oh, I'm sorry, just looked at 58. And wait, why does this go back up? Oh, I'm not even looking at the money, like a dork. 52. So you can see, you know, the leaps, 14, and let's look at December is a month difference. A month of time decay between January 2026 and December 2025, and theta only changed one. But a month from 45 days to expiration to 15 days to expiration is going to change from 48 to 77. So you can see that theta's rate of acceleration is much greater under 90 days And out at a year long, it just doesn't matter. It's draining a tiny a bit amount, which is why I don't sell covered calls out to 368 days to expiration, even though, at the money, I could get paid $11,000 instead of the $1,000 that I can get for next week. So yes, I could get paid 10x out here, but Theta is so small, I would have to wait months upon months upon months to be able to buy this back for cheaper. And that's the name of this game, is not just selling high and buying low, but selling high and buying low as soon as humanly possible so that I can repurpose that collateral and do it again. Sell it high, buy it low, sell it high, buy it low. And when Theta is accelerating at its maximum at 45 days to expiration, that isn't a theoretical advantage. It's a mechanical advantage of choosing the option that fits the strategy. So, absolutely. I will not be holding my long calls under 90 days when that starts to become an advantage to the person who sold it to me. Right now, as a buyer, and it's got 180 days to expiration left on it, the advantage is to me because it's decaying very slowly. I want to own something that's very far out that's decaying slowly, and I want to sell something that has a close expiration that's decaying quickly. So, not exactly a theoretical advantage, but more of a mechanical one of choosing the strikes and days to expiration that matches the strategy. All right, let me jump back into the joint account. I've only got 100 shares in this account. I've got a few long calls. And I think this one was I tried to sell another cover call against these 4 leaps, but I don't think the algorithm let me let me do it. So that's fine. Let's go ahead and close this one. I can buy it back for less than half of what I sold it for. This is gonna put me in a little bit of margin use, which I'm trying to avoid. So, do I roll this down for a credit, or do I just sell a couple shares? I gotta come up with 500 bucks. Yeah, why not? I'll roll it down to the 320. Collect 1100. Now I've got 700 to spend. Do I have anything I can dollar cost average into? Not really. My December's cost 9 grand. Okay, so I can either I can buy 2 shares. Let's just go ahead and do that. All right. No cash. In order to close those positions like on Thursday, I'll probably have to sell those shares right back. Um, that's fine. All right, this is my discretionary spending account. I've got the one covered call against this leaps. This leaps is not quite as in the money as it should. It's technically out of the money. It's only worth 63 delta, which is 70s better. But again, I could probably sell, if I take the strike plus its value, I could probably sell the 355 or higher. Seriously, the 455 or higher relatively safely. And this one is the 470, so that's fine. Again, I can buy this back for half of what I paid. So I'm going to go ahead and roll this out to 46 days to expiration. And what did I say? Around the 455 I can do. So I can get a little bit of a credit here. If I can get a fill. All right, I got 900 bucks to spend. The June 1080s are a little bit too expensive. But if I sell the 2 remaining shares I have, I can just pull it off, I think. That gives me 1,600 bucks. And if I go to June, yep, I can just grab one more. Concentration risk. Oh, I must be I have like 100 shares that I'm trying to buy in here. That's hilarious. No, I cannot buy 100 shares with this account. All right, cool. No cash. I have no shares. Got one covered call position on. All right. I like that. I need to take a look at my 5K account because I got assigned shares over the weekend. I sold puts in CLSK and Riot. Let me just check the chats again real quick. So Apollonia says today not necessarily a good day to put on covered calls. That is true. So in general, if you want to just ignore all of the metrics and just look at, is it green? That's a good day to put on covered calls. Is it red? That's a good day to take off covered calls. That's if you don't know anything more than that, that's kind of like that'll 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 help you at least improve your success rate probably. However, on a red day, if I'm taking off covered calls, I have to decide, do I want to just take them off and leave them off? And to do that, now I'm not collecting any theta if I take all of them off. So in most of the cases, I have, what, take off 5, put back 3 on and collect a credit. Um, so yes, optimally, green day, you're adding, covered calls, and on a red day, you would be closing them out and booking some of those profits. Um, However, if you want to collect more premium, you can, instead of just closing that position outright on a red day, you can roll it down to collect additional premium. Now, that capture upside at a lower number, and if the price of MicroStrategy reverses before my expiration date, then I have thrown away a bunch of upside. So that's the trade-off. If you don't want to roll them down and you want to bag hold for a green day, there's nothing wrong with that. And then says IV at 112, IV rank at 28. Yeah, exactly. So, and I'm not sure which. I know there's different sites that use different IV rank calculations. So Tasty Trade is saying MicroStrategy's IV rank is 37, which has been steadily going down. It was like 40s and 50s over the last couple of weeks. And it's been kind of contracting since then. But yes, absolutely. Tasty Trade definitely tends to peg like anything over 50 is starting to get into prime covered call selling range. But yeah, when you're going to close it on a red day, you have the option of just closing it out completely or rolling it down for an additional credit. And while IV rank is down, the premiums are still pretty juicy. So, um, in some of the cases, I opted to leave them on. Like if I didn't have any covered call in this account, my negative theta would be even greater. Because of all of this long call exposure that I have, I've got like $137 draining out of this account every day. And adding a covered call here at least kind of maybe I don't have that exactly right. Um anyway, it's saying my net theta is minus 68 and the covered call position that I just put on is 25, so that doesn't compute. Oh, I'm sorry. 25. I'm looking at the fucking delta. What a dork. Theta's 44. So that makes more sense. 97 and 16 is 113 minus 44. Yeah, that works out to 69. Okay. My math wasn't mathed. I was looking at the wrong column. But yes, you're absolutely correct, Apollonius. Dr. Van Nostrand says, do you expect the prices of the January 17th expiry to decrease significantly between now and the 16th? Josh has been hyping up the Gamma Squeeze, and I was thinking of buying a small lotto ticket Thursday morning. Yeah, so if you're wanting something to happen on the 17th, then you don't necessarily want to buy it now because the price could be, 305 on Thursday, and you're going to lose a bunch of your value. And the price of that option is going to be decaying today, tomorrow, Wednesday, and overnight. So if you're making a play for something to happen on a particular day, you'd probably want to do it the day before. So sometime on the 16th, if you're looking to buy, that's going to allow you to buy at Thursday's price. And if nothing happens between Thursday and Friday, the only thing that you're losing is 1 day of decay. Um, if you actually select the 17th as your expiration date, now you're really limiting your time to be right. And I got to check with Josh and see if he's literally buying things that expire on the 17th or if he's buying things that expire in February, March, April. I'm not sure what his exact strategy is going to be. I mean, if he's already said exactly what he's going to be doing, feel free to throw that in the chat. But I'm not aware of what expiration dates he's choosing. But yeah, if you're expecting anything when you choose an exact date, that's called a binary event. Like election night was a binary event. Inauguration day is going to be a binary event. Earnings calls are binary events. Things like investor days, pharmaceutical stocks, if when they're expecting the FDA to make a decision on something, whether they get approvals or blah blah blah. Those are all binary events. And if you're hanging your hopes on a binary event, you don't necessarily want to buy it weeks and months out because that position is just going to decay until the event happens. So, yeah. for the 17th, I'll just be taking my positions on the 16th. And I really like the idea of choosing something that's, 90 days out. So what is that? The February, March, April's. So maybe the April's, but those are going to be much more expensive. Something that expires on the 24th is going to be super cheap compared to something that has time to be right. So I'm still on the fence about what expirations and strikes I'll be looking at on Thursday. Richard says, "Thanks for going through all of this with us, learning so much. Glad to hear it." And Dr. Van says, "Okay, cool, thanks. Yeah, I don't know if I will buy the 17th expiry or not. I know he thinks it may start on the 16th, though." Yeah, and I don't know if it's going to be like the 17th as a springboard for the next rally, and maybe that takes 2 or 3 weeks or a month or 2 months. I don't really know. Um, the last time I was psyched about something happened. I think it was like QQQ inclusion, and maybe something was going to happen over Thanksgiving, and jack shit happened. Um, and Jeff Park even thought that January 10th was a more likely gamma squeeze than the 17th, and jack shit happened last week either. So I'm definitely not throwing down, like I'm not pushing all in, and and risking ruin. But yeah, I'll be doing something, meaningful enough that it'll actually matter and be fun, but, nothing that can hurt me in the long run. And then yeah, exactly. The if you just have 1 day left, those contracts will be dirt cheap, but they're dirt cheap for a reason because the price can totally go against you. Jeremy says, "I think Josh said he was gonna purchase before the close." Oh, on the 15th, not sure on duration. He said he will tweet it out shortly after. Okay. I was thinking it was on the 16th. And that's how I do my earnings plays. So I haven't really done them for months, but if I'm going to, sell puts um, on a company before earnings, I do it right before the earnings report. So right before the close, and then after earnings, after 15 minutes after the market opens the next day, then I just close that position. Yeah, so I don't know what the advantage of doing it on the 15th would be because that's an extra trading day. Unless the market makers start to unwind those positions the day before expiration. I don't know. Yeah, I'm not I'm not as very sophisticated with those types of trades, so I'm just I'm learning about that kind of shit just like everybody else. All right, so I have 800 shares of CLSK and 800 shares of Riot. I only have 7 covered calls and 7 covered calls. So, especially in these accounts, I don't really worry about whether something's red or green. I just want to be collecting theta. So I'm gonna hit trade all options, sell a call. I could sell the 11 again just to make it easier for me to manage these trades on Friday. So I think I'll just go ahead and do that. Let me just add another one. Same for Riot. That is a little bit too cheap for me. I generally try to collect either 10% call away value or 1% premium at least. If I can make both of those happen, great. So if I sell the 1250 or the 13 I can get both of those criteria meet. 10% call away value and 1% guaranteed return on capital. So let's see if I can get this to fill. Nice. Okay, let's check my buying power. I think I have a very low margin use in this account. That's fine. Yeah, I'm only using 600 bucks worth of margin. I think that's reasonable. Let's see, my 221 covered call. Okay. I sold it for 8 and it's actually gone against me a little bit. So yeah, nothing for me to do here. I'll just sit on this. Yep, this account's good to go. So let's get caught up on the chat. Apollonia says, I love Josh, but the stars have to align for his gamma rocket. Yeah, exactly. And I think he's even admitted that he can be wrong as everyone can. So I will be participating, but position size, you can flip a coin and say whether position size, it's probably position size is the most important aspect in a trade, but liquidity is right up there. If you size the position so that it can't destroy you, then you can live to fight another day. So position size is king. And then liquidity is kind of right there in that same boat because you can't make money if you can't get into and out of the trade. It's usually a lot easier to get into a trade. And then when it's profitable, if you can't find someone to to uh participate in you exiting that trade, then what good does it do you if you're trapped in a winning trade that you can't book profits in? So position size and liquidity are the two most important factors in any trade, but in options particularly since everything is leveraged. All right, we're all caught up, and I appreciate everybody for joining in. And